Doing your taxes doesn't have to be taxing. What you need to know before you file. Materials provided by Genesis Financial Management. Who has to file? Income thresholds. Each year, the IRS establishes income limits that help filers determine based on their filing status and age if they must file a return or not. If your income falls below the limits, you may not need to file. Rules for dependents. If you're claimed as a dependent by a parent or someone else, you may still need to file a return even if your income was below the stated limits. Whether or not you must file is based on your age, filing status, and how much you earn and unearned income you had. Special situations. Even if considering all the other criteria, you wouldn't have to file a return, you may still need to if you owe certain special taxes, such as additional tax on qualified retirement plan or Social Security and Medicare taxes on tips you didn't report to an employer or on wages you received from an employer who did not withhold these taxes. Also, you may need to file if you received an advance earned income credit payments during the year, had earnings from self-employment, and or earnings from work done for a church or church-controlled organization that is exempt from Social Security and Medicare taxes. Who should file? When a refund is owed, if any employer you worked for withheld federal income taxes from your paycheck or you made estimated quarterly tax payments during the year and you believe that you're entitled to a refund, you should file. When eligible for an earned income tax credit, this is a refundable credit, meaning that you qualify for it. You should file a return to claim it even if you wouldn't otherwise owe taxes or need to file. When eligible for a additional child tax credit, this is also a refundable credit that can result in a refund to you even if you don't otherwise owe taxes, but you do have to file to get it. When eligible for health coverage tax credit, you may be able to claim this credit if you meet certain criteria. If eligible, you may be able to take a credit of up to 65% of the amounts you paid for qualified health insurance coverage for you and any qualifying family members. What filing status do I use? Single, unmarried, or legally separated from the spouse as of the last day of the year, and you do not qualify for any other filing statuses. Married filing jointly or separately, both are available to married persons and you can choose to do either one. If you choose or are required to married filing separate status, just be aware that your tax may be higher, your tax standard deduction amount may be lower, and you may lose certain tax benefits that are only available under the married filing joint status. Head of household. You paid more than half the cost of keeping up the home for the year, and you have a qualifying person that lived with you in the home for more than half the year. Qualifying widow or widower. If your spouse died in the preceding tax year, you can use the married filing jointly status for that year. If you paid over half the cost of keeping up a home lived in for more than half the year by a qualifying person, you may be able to use the qualifying widow or widower with dependent child as your status for 2 years following the year your spouse died. This enables you to use the joint tax return rates and highest standard deduction amount. Exemptions and dependents. Exemptions reduce your taxable income. Exemption amounts generally increase a little each year. In order to claim an exemption for a qualifying child or relative, you must meet these three tests. Dependency. You cannot claim an exemption for a dependent if you are already claimed by someone else as a dependent. Joint return. You generally cannot claim a married person as a dependent if they file a joint return. And citizenship or residency. You cannot claim someone as a dependent unless they are a U.S. citizen, resident alien, U.S. national, or a resident of Canada or Mexico for some part of the year. There is an exception for some adopted children. Personal exemption. You can take one for you and one for your spouse. You cannot claim if someone else claims you as a dependent on their return. Exemptions for descendants. They can take one for each qualifying child or dependent and must meet dependency, joint return, and citizenship or residency tests. Who qualifies as a dependent? A child must meet each of the four tests to be claimed as a dependent. Relationship must be your son, daughter, stepchild, foster child, brother, sister, half-brother, half-sister, stepbrother, stepsister, or a descendant of any of them. Age. The child must be either under the age of 19 at the end of the year, under the age of 24 at the end of the year and a full-time student, or any age if permanently and totally disabled. Residency. The child must have lived with you for more than half the year. Support. The child must not have provided for more than half of his or her own support. A relative must meet four tests to be claimed as a dependent, not a qualifying child, member of household or relationship test. They must be related to you and must live with you all year as a member of your household. Gross income. Their gross income must be less than the stated IRS limits. Support test. You must provide more than half their total support. Not all income is taxable. Example of income that isn't taxable: child support, gifts, bequests, inheritances, insurance proceeds, SSI, TANF, veterans benefits, workers' compensation, life insurance lump sum payouts. Some surprising, maybe, sources of taxable income: settled debt, gambling winnings, unemployment benefits, jury duty pay. There may be exceptions to some of these. For example, if a debt is forgiven because it's discharged in a bankruptcy or because you're declared insolvent, you may not have to include it in taxable income. If your employer requires you to turn over jury duty compensation to them, they continue to pay your salary while you're serving, you can deduct the amount turned over to your employer as an adjustment to income. Small business income. You'll need to attach a Schedule C or a CEZ to your tax return. You can use the Schedule C-EZ if all of the following apply. You had a business expense of less than $5,000, used the cash method of accounting, did not have an inventory at the time during the year, did not have a net loss from business, had only one business as a sole proprietorship, had no employees, are not required to file a special form claiming depreciation for the business, do not plan to deduct expenses for business use of your home, and you do not have prior year unallowed passive activity losses from your business. What you report on your tax return is the net gain or loss after accounting for all expenses. What kinds of things can you deduct from business income? Vehicle expenses, depreciation of property, insurance premiums, legal and professional fees, advertising, office supplies. You may be able to figure out a deduction for each business use of your home if you meet specific criteria. Like A, the part of your home that's used for business is used exclusively for that purpose and not for personal use. B, you must use that area of your home on a regular basis. C, even if you use more than one location to operate your business, your home must be the principal location. If your home meets these tests, you may be able to deduct the cost for utilities, insurance, etc., based on the formula that takes into account the percentage of your home that is used for business versus the percentage of your home that's used for personal use. Independent contractors. If you're treated as an independent contractor by an employer, that means you receive a 1099 form and no taxes are withheld from your paychecks. Your income is treated by the IRS much like a small business income. Independent contractors should think like small business owners and keep all records of potentially deductible expenses like mileage, uniforms, business supplies, etc. That could help offset the income. Small business and taxes. Federal income tax is a pay-as-you-go system with two ways to pay, either through employer withholdings or estimated tax payments. If you work for someone else, they may withhold taxes from each paycheck based on the withholding allowances you claimed when you filed a W-4 form with them. Small business owners and independent contractors usually have to be responsible for paying their own taxes throughout the year. The best way to do this is through estimated payments. Use the form 1040-ES to help figure out how much you may need to pay through estimated taxes based on anticipated income. You then pay taxes on quarterly basis throughout the year. Self-employment tax. A Social Security and Medicare tax for small business owners. You must pay SE tax and file Schedule SE if your net earnings from self-employment exceed $400 or you had church employee income of $108.28 or more. Adjustments to income. Deductions to gross income that help determine adjusted gross income. Also called above the line deductions because they help you calculate your actual taxable income as opposed to tax credits, which are below the line. Deductions that actually reduce the amount of any tax you have to pay. You'll find the adjustments section on page 1 of the 1040 form, right below where you figure your total income for the year. Common adjustments. Contributions to traditional retirement accounts, alimony you pay, student loan interest you pay, moving expenses, half of self-employment tax. Standard versus itemized deductions. Standard. Predetermined allowance that may be claimed by filers in lieu of itemizing. Cannot use if you are married filing separate and spouse itemizes. Amount varies based on the filing status, age, and exemptions. Itemized deductions. It makes sense if your total qualifying deductions add up to more than the standard amount. You must use a Schedule A. You must use if married filing separate and spouse is itemizing. Common itemized deductions. Healthcare, housing, and charitable. Additional deductions. Unreimbursed employee expenses like mileage, uniforms, required certifications, etc. Tax preparation fees, safe deposit rent, gambling losses. Many of these expenses fall under the category of miscellaneous. Typically, you can only deduct the small portion of miscellaneous expenses that exceed 2% of your adjusted gross income. Credits that can help reduce taxes. Adjustments and deductions reduce taxable income. Tax credits reduce actual tax liability. For example, assume a tax filer filing status head of household with one dependent with a $40,000 adjusted gross income. Based on 2007 numbers, this person could claim a standard deduction of $7,850. They could also claim two exemptions, one for them and one for their dependent, totaling $6,800. After subtracting the standard deduction and the two exemptions from their adjusted gross income, their taxable income would be $25,350. According to the tax tables for 2007, they would owe $3,246. Let's say they also pay $200 interest on a student loan. That extra adjustment would bring their adjusted gross income to $39,800. After subtracting the standard deduction and exemptions, their taxable income would be $25,150. Their tax would be $3,216. An extra $200 in adjustments saved them $30 in taxes. However, let's just say a person also paid $1,000 for childcare during the course of their year. They could potentially qualify for the Child and Dependent Care Credit, which would enable them to directly subtract that 1,000 from the taxes that they owe. So 3,246 minus $1,000 equals $2,246. Common credits. Child and Dependent Care Credit, Child Tax Credit, Additional Child Tax Credit, Education Credits, Retirement Savings Contribution Credit, Earned Income Tax Credit. A credit for working individuals and families who meet the following criteria: income guidelines, age, valid Social Security number, not using married filing jointly status, citizen or resident alien, investment income not exceeding certain thresholds. When credits may not apply. Some tax credits are refundable, meaning you'll receive them even if you don't otherwise owe any tax. You'll still have to file a return to claim them. Earned income tax credit is a refundable credit. Other credits are non-refundable, meaning you will only receive them to the extent that they offset any tax you owe. If you don't owe any tax, you won't get these credits. Tax brackets. How many of you know what your tax rate is? This is an important concept because this is the rate at which your last dollar earned is taxed. It tells you how much of the extra earnings from a bonus, raise, investment income, etc. you get to keep, and it also can help you figure out the tax savings benefits of a tax deductible expense. The effects of tax rates. Angela has a taxable income after deductions and adjustments of $33,000. As a single person, this means her tax rate is 25%. However, if she decides to contribute $3,000 to an IRA during this year, this could reduce her taxable income to $30,000, which now puts her in the 15% bracket. There's a real difference between tax avoidance, which is legal, and tax evasion, which is not. Each year, many filers unknowingly pay more than they need to due to filing errors or neglecting to claim adjustments, deductions, or credits to which they may have been entitled to. How can I legally reduce my tax liability? Increase contributions to tax deferred plans, watch your credits, adjust filing statuses, keep good records of deductions. Over withholding. Are you used to getting a large refund every year? Reconsider over withholding. Adjusting withholding allowances might help balance your budget. This can be a means of forced savings for those who can't save any other way, but consider this. You're giving the government free use of all that extra money for a year before they give it back to you. Why let them earn interest on it when you could be saving or investing it for yourself throughout the year and earning and keeping that interest for yourself? Adjusting withholdings. More exemptions, more money in your paycheck. Fewer exemptions, less money in your paycheck. You can make changes to your W-4 form at any time. Simply ask your employer for a new copy or print one off from the irs.gov. What if I owe and I can't pay? You have to still file by April 15th deadline. Extension of time to file does not mean extension of time to pay. Consider requesting an installment agreement. If you absolutely cannot pay your balance due in full, you can request an installment plan by using Form 9465, or perhaps consider a low-interest banking loan to pay off the taxes. The IRS will charge a fee for approving the installment plan and may continue to add interest to any amounts not paid by April 15. Your proposed plan must enable you to pay the balance in full within 3 years or less. If you receive a refund in future years, the IRS may tap that refund to help pay off your balance from previous years. Filing back taxes. You have up to 3 years to file a return on which the IRS owed you a refund. If you owe the IRS money for the previous year, it never expires. File it as soon as possible. Refund anticipation loans, often marketed as fast cash refunds, instant refunds, or same-day refunds. You pay to borrow your own money. The appeal of getting your refund fast is undeniable, especially if you've already got big plans for it. But why sacrifice part of the refund just to get it a few days faster? In addition to the upfront cost, the other hazard with refund anticipation loans is that they're often based on estimates of your tax liability. If for some reason your actual tax liability is greater, you may end up having to pay back that refund. Alternatives to refund anticipation loans. E-file, direct deposit, free file options online. If you submit your return using electronic filing or e-filing, it will reach the IRS much faster than by emailing, meaning that they can process it faster, and you also elect for direct deposit or any refund into the bank account. You could receive your refund in about 7 to 10 business days as opposed to 4 to 6 weeks if you opt for paper checks. If you meet income criteria, the IRS also offers a number of free file options through affiliated partners. You can do your taxes yourself using your free online software. Help for taxpayers in trouble. IRS Taxpayer Advocate Service, 877-777-4778. The IRS offers a free taxpayer advocate service, which is an agency operating under the umbrella of the IRS but focused on representing customers who are having difficulty resolving tax issues with the IRS. The Taxpayer Advocate Service is an independent organization within the IRS whose employees assist taxpayers who are experiencing economic harm, who are seeking help in resolving tax problems that have not been resolved through normal channels, or who believe that the IRS system system or procedure is not working as it should. Websites worth checking: www.irs.gov, www.thebenefitbank.org, www.uwtb.org/free tax help. Questions, comments, concerns? If you have any questions and want to contact a certified personal financial counselor, you can call us at 877-202-9246 or visit us at www.yourgfm.org. Thank you.